Well, you heard the words, enormously opportunistic. That from BlackRock CEO Larry Fink on CNBC earlier today. But my next guest is taking a opposite approach, decidedly opposite. He's hunkering down for the year ahead. Let's bring in Sebastien Page, T. Rowe Price, head of global multi-asset and the chief investment officer. Welcome. I mean, you guys couldn't be more opposed. What Mr. Fink had to say, and when I look at your positioning, wow, you're underweight stocks, you're neutral bonds, and you're long cash. What's coming this way?
Look, we're playing defense for sure. We're still diversified between stocks and bonds. I wouldn't argue to go all in cash. In fact, I wouldn't argue to do that in any market environment. But look, Scott, the yield curve's inverted. PMIs are dropping like a stone. Recession risk is there. It's rising. We have to deal with the lagged effects of Fed tightening. We're predicting a drop of about 7% in house prices for this year. So there are reasons to play defense. Now, I got to say, though, the nature of defense is going to be different in 2023 versus 2022. I do think bonds have a role to play in defense in 2023 because we're more worried about a growth shock than a rate shock.
I mean, there are some who would suggest that bonds not only have a role to play, that they have a starring role. They're not a supporting actor. They're the lead, right? That's the one thing that Gundlach said earlier this week. Forget 60-40, go 40-60.
Yeah, well said on bonds. The role of bonds right now is more important than it has been in many, many, many years in the portfolio. Look, here's one way to think about this. Stocks, relative to rates, right now are actually more expensive than they were before the 2022 sell-off. So that's if you compare, say, the earnings yield on stocks, which has gone up, right, by about 100 basis points because the price-earnings ratio has gone down. But the yield in a 10-year has gone up by 180 basis points. So there are reasons to play defense. I'm not an uber bear. I know, Scott, we're trying to say like completely opposite view of your previous guest. It's more subtle than that. We're actually playing offense under the hood.
No,
but we are positioned mainly for defense.
I hear you, of course. But when you are underweight stocks, neutral bonds, and long cash, I mean, it projects a fair amount of negativity towards your current view, at least, of the market. Is that because you believe the Fed? Right? We do have this battle right now, and I think that's the conversation in the market is the bond market versus the Fed. And, people thinking that the bond market's going to win, some suggesting, including the Fed, that it's going to win. You must be siding with the Fed.
Look, the Fed's tightening has been so drastic at 450 basis points in 10 months. A lot of that shock is already priced in, right? We've had the rate shock now. Rate volatility will remain high. But yes, I go back to the lagged effects of Fed tightening on the economy. And I give you the example of housing prices, which, by the way, are dropping, have dropped, even though your CPI print is showing shelter inflation going up. That's just because of the lag.
Right.
Our models are showing, like if you look at the houses that are listed on Redfin for sale, like sitting on the markets, and you build a model off of that, it'll predict a drop of 7%. That's not small for the housing market in the U.S.